All right, so welcome everyone to our webinar. This is our second webinar for the year, so I'm pretty excited about that. As tax season approaches, I don't know when the next one will be. But the rest of our webinars are usually in person, so if you are interested in that, we can let you know if we're in your city. So today we're going to be speaking about tax saving tips for entrepreneurs. We are Libris Connect Consultancy. We are business consultants and tax professionals. We've opened the doors for auto mechanic shops, laundromats, grocery stores, hair salons, you name it, we've done it. We've opened quite a few brick and mortar locations, and we've helped grow a lot of virtual as well as physical businesses that operate in a brick and mortar space. Our services are tax services. We do consulting, we do complete setup assessments, and then we do complete business setups as well, employee training, and then let's jump over to bookkeeping, where we keep your financial statements, pretty clean so you know what's really happening with your business. All right. Okay, so I'm going to jump right into it. And I'll touch base with you if I'm going too fast because I'm a speed talker at times. So I will touch base with you all to see how you're doing. But I wanted to break down the different business entity types and how they are taxed federally. This is more geared toward the US. I'm going to be honest and say that, but certain tips that I see that are, for the most part, general, I will specifically state those out. All right, so on a federal level, there are different ways in which you're taxed based on how your business is registered or how it's structured. So if you are a sole proprietor, meaning you just do business without registering anything with the state, or if you have an LLC and it's just you, you are automatically taxed as a disregarded entity. Essentially, you would just attach a profit and loss statement to your regular 1040, or your tax preparer would do that. And you are taxed at the tax rate of 15.3% for self-employment tax. So you notice, like, when you have your wages, they automatically deduct those taxes, retirement, federal taxes from your pay. They usually amount to about 15.3. That's what's paid over. Your employer will match part of it. But when you're self-employed, you are automatically responsible for it. So when you're self-employed and you have an LLC, automatically with the IRS, that's how you're taxed. You are responsible for self-employment tax in addition to income tax. All right. If you have any questions, let me know and I'll touch base in the chat. All right, so another option is, let's say you registered an LLC or you registered a partnership with your state. You are automatically taxed like a partnership once there's 2 or more persons in your business. That's just automatic with the IRS. You file a partnership information return, and then that's usually around March. Some businesses have different rules. You get a K-1 from the business, and you may be subjected to self-employment tax that we spoke about before. So again, let's to go over that. If you have 2 or more persons in your business in the US, you are automatically taxed like a partnership, and you do an information return for the partnership for the business, and that information return will give you a K-1, and that's like a little statement of how much money you made, how much money you put out, and it determines how you're taxed on your actual personal tax return. You are generally subject to self-employment tax. However, if you're a limited partner or an investor, you may not be subjected to self-employment tax in a partnership. All right. I know it's quite a lot, but I'm going to kind of breeze through these so you kind of have an understanding, and I'll provide the recording for this as well. Another way you are taxed is as a corporation. You can register at the state level. You'd see a business that says, let's say, for example, INC at the end of it, or a corporation at the end of it. Those businesses are mostly registered at the state level, and they're not subject to self-employment tax, so that's pretty great. You can elect to be taxed as a corporation. The maximum tax that you pay is 21% at the corp level. And then for your federal return, you're going to pay taxes again. So the only downside I've seen so far is the double tax part. And if you have like real estate, I wouldn't recommend you keep those under your corporation. Let's say that if the corporation bought a property for itself, unless, you know, there's ways and means around that, generally a tax person will, or accountants will advise against having like a property under that. Let me check to see if I've lost anyone. Is everybody good with the information so far? We're going to go to ways to save. So while I'm looking to see if there's anything in the chat, I do want to say, okay, based on what I've said, if you're a single member, it's the same tax return that you filed for your personal taxes if you live in the US, and then you attach a profit and loss statement to that. And then you may be subject to self-employment depending on your income. If there are two or more persons, you're automatically a partnership and you do an information return for your business. And you're still also subjected to self-employment tax. So just so you guys understand what the different tax structures were, I just threw the corporation in there so you have that info. All right, are we all good? Can I move forward? All right, let's do that. All right, let's talk about ways to save. I'm pretty sure many of you have seen like videos on the internet where they're saying you should switch over to an S Corp. Switch over to an S Corp. So you can pay less taxes. A little bit about that. An S Corp is not necessarily something that you register with your state. It's an election that you make with the IRS. All right. So you can be an LLC and switch over to an S Corp to be taxed as an S Corp. You can be a regular corporation and ask to be taxed as an S Corp, or you can be a sole proprietor and request to be taxed like an S Corp with the IRS. I recommend that when your income is around 60,000, it's pretty consistent. That's the best time to go about switching over to being an S Corp. The beautiful part about an S Corp is you are not necessarily subjected to self-employment tax, right? But the catch with an S Corp is what nobody really tells you about is you must take reasonable compensation. So you are somewhat separate from the business, and a W-2 is required. So you have to make sure you're taking those payroll taxes and you're paying yourself every week. And of course, that's where we would come in. But essentially, you wouldn't be subjected to that 15.3% if the business made, let's say, 600,000 one year, right? The business made 600,000 one year, and the service you offer for the business is, let's say for myself, a consultant, the income would range. Let's say I paid myself 200,000 because that's pretty fair for what I do, right? For the year, I would only pay self-employment tax. I would only pay those taxes on those payroll taxes for myself. So that's the beautiful part about an S Corp. It is an election that you make with the IRS. And once you go S Corp, you stay S Corp for 5 years. So it's always important that you think about that, especially when your business starts to go up to about 60K or so, and it's pretty consistent and you don't want to be paying like a huge amount in taxes. You can save a lot on self-employment taxes with switching to an S Corp. All right, let me know if you have any questions, and I'll do see a couple questions there. I'll get to them shortly. But if you have any questions or I've lost you anywhere, be sure to let me know, okay? All right. Another way to save on taxes is to make estimated payments. It sounds a little bit crazy, but it's always good to make estimated payments because when you're making estimated payments, and that is to the IRS. So instead of waiting at the end of the year and your tax person is like, oh, you have to pay this amount of money to the IRS, and you're like, wait, I didn't know that. The best way to go about avoiding this is to make estimated payments. When you make those estimated payments, you know where you're at financially, you know how much money your business has made, and you're able to be more strategic. Okay, maybe I need to do something here or purchase something additionally. Maybe I need to contribute to some retirement account, because those estimated payments show you, okay, this is what I've made, that's what I'm going to be taxed. Next quarter, I need to do this. So estimated payments helps. And why I believe it's pretty helpful is you're not going to be left wondering how much you owe. And at the end of the year, when tax is over, you have this big lump sum to pay and you don't know what to do. And then on top of that, those payments are attracting interest and penalties. And they don't stop until you actually pay them in full. All right. All right. So, and then another thing that I must mention is regarding those, making sure you make the estimated payments, is knowing that the IRS has increased interest rates. So for individuals, if you underpaid, it's a 7% per year compounded daily. So it's 7% tax for the year. You know, that 7% adds up. If you owe, let's say, $15,000, 7% is a lot. And then, you know, if you're a business, if you have a corporation or so, if you've overpaid or underpaid by a certain amount, those penalties are pretty significant. And you don't want to be giving the IRS more money than, you know, they need. All right. Okay, so here's another way to save on taxes. You can pay your children. So I had one lady, she had a hair salon, giving you an example here, right? She had a hair salon and her daughter was there. The daughter was about 14. She was helping a lot around the store or the salon or the shop. And she was doing the services and filling in for staff that didn't show up to work. You know, the only thing she wasn't doing was actually doing hair. She was sweeping the shop. She was billing customers out, of course, not in her school time. And I said to her, you need to put her on payroll. And that's a wonderful tax deduction. As long as they're able to do the work that you say they have, and you're able to track and record all the payments that you've made to them. Let's say they worked a certain hours, log those hours. Let's say you pay them a certain amount, a fair amount. You know, she can't be in there making $60 an hour in the shop, but they're able to collect up to a certain amount that is under the taxable threshold for the IRS. And that would not be a taxable event if they make under the tax threshold. And that would be for the filing status that they have. Let me know if everyone is following and if you have any questions. All right, I see some questions there, so I will check it in about 2 minutes. All right, so as I said before, depending on the business structure, you can pay your little helpers and write them off on your taxes, right? You just have to keep really good records. That's the part they don't tell you about when you're watching those videos online. You have to keep really good records of the hours they work, records of the roles they had. And it has to be reasonable, nothing unreasonable, okay? All right. Another thing is issuing 1099s or W-2s, right? Oftentimes, I've been guilty of this as well. I had at my office, a few years ago at my office, I had a gentleman come and he did some work for me. He didn't have a business. I paid him about $3,000 or so. And I almost forgot to ask. He wasn't an employee of mine, but I paid him about $3,000 to do some work on an office space I had. And I had him fill out a W-9 form, and I have a video on that. I can link that in a video summary after this so you guys can have that. I had him fill out a W-9 for the work done. Once someone's done over $600 worth of services for you, you can give them a 1099. They just need to fill out the W-9 form, and I will link that in a summary video to you guys. All right. And then you can write that off on your taxes. So that's pretty important. Those monies that you're spending out, those are write-offs, especially if they're business-related expenses. If somebody's coming to your business place and they're doing work, be sure to maximize your tax savings by tracking all that. That is pretty important. That $3,000, I could have easily forgotten about that had I not made sure I had him fill out a W-9 so I could give him a 1099 at the end of the year. All right. Another thing I would say is track your expenses. I have clients who do not track their expenses, and that's why I offer bookkeeping services. Oftentimes, a few clients would be a little bit, they'll push back on why they need to be doing bookkeeping. And I'll push back to them as well, because tracking your expenses are important, right? Let's say you decide you're going to do your own books, right? If you are not privy of what the taxable deductions are, you could be losing a lot of money. I had one client, he was able to save $70,000 in write-offs because he just had everything all over the place. It's absolutely important that you track your expenses. It's so easy to get caught up in, oh yeah, I have this receipt here. Oh yeah, I have that receipt there. If you are not aware of your expenses or categorizing your expenses properly, there's no way you're going to remember them all, right? So this is a snippet from the profit and loss statement, the Schedule C, for self-employed individuals, so sole proprietors, single member LLCs. I snipped this off of it, but these expenses are generally on the other statements as well, the different entity types. Advertising. If you spend money on ads, that's an expense. If you spent money on your website, that is an expense. If someone comes to your business place and they offer a certain service and they don't really have a business, get their information on a W-9 form. And then you can also, just to make sure they haven't like given you incorrect information, you can also request to see their IDs to make sure the social security number they give you is actually theirs and the name they've given you is actually correct from their driver's license. So that would be right here, line 11. There's depreciation of assets. Depreciation is a write-off, right? Insurance, if you're paying for insurance, like general liability insurance, that's a write-off, right? If you have a business place and you're paying mortgage, that's a write-off. If you paid your tax professional to do your taxes, if you paid for, let's say, the registration of your business, those are write-offs. Those are expenses that you can write off, right? And of course, not for the personal side of the taxes, but the business side. That portion of it is tax deductible for the business. And as you can see, there's like travel and meals. Those are write-offs as well. So if you have to travel for your business, that's a write-off. And repairs and maintenance, supplies. You just have to be very mindful of how important it is to do your books. That guy saved $70,000 one year. I was like, how are you paying IRS this much money? He wasn't doing his books. He just estimated that that's how much money he spent and he forgot a lot of stuff and he saved 70 grand. So don't be that guy, right? Don't be that guy. Is everyone still with me? Okay. All right. So of course, hire a bookkeeper. We offer that service. We'd love to have you. And let's look at another tax saving. Business retirement plans. I have some customers who are hybrid. They're still working a job where they have a 401k. They may have an IRA and they have a business. The companies like Charles Schwab, I think TD switched over to Charles Schwab. I would say you can set up a retirement plan with them through your business. And the contributions that you can make are in addition to what you already have. So it's in addition to your 401k. So if you already have a 401k, you can make contributions to your own business retirement account. So you can set up an account with Charles Schwab. You can speak with someone to see what the different options are. And they'll tell you the maximum contributions. And believe me, a lot of times they're more than you would expect, right? And those can be deductions. Those can be deductions on your taxes. All right. Okay, so let's talk about depreciation. All right, so if you bought, let's say, furniture for your business, right? If you have furniture for your business, if you have, let's say, furniture, you bought, let's say, a heater, a lot of things can be depreciated. Even your vehicle can be depreciated. And there are different depreciation options. There's the regular maker's depreciation, where it's depreciated based on a number of time, and it's categorized by the IRS. They tell you how many years a specific thing can be depreciated, right? And then there's bonus depreciation, where you can, I think for 2020, I believe for 2023, it's up to 80%. You can depreciate 80% of your purchases. Of course, there are limitations as to what can be depreciated and the age of when the asset was placed into service for your business. So it's really dependent on when you made it available for for your business, right? And of course, there's Section 179. So these are different types of depreciation options: makers, bonus, and Section 179. So if you have assets, be sure to ask your accountant, or make me your accountant, and have them tell you if you qualify for depreciation for any of these options, and that's a write-off on your taxes, right? Okay, let's look at another thing you can expense. Business vehicle expenses. There are different ways you can actually expense your vehicle for your business. So most of depending on the type of client. So if you do Uber, DoorDash, and you're putting heavy mileage on your car, rideshare services, then of course it's best to depreciate the mileage. However, there's the option. Let's say one year you did a lot of fixing on the car, you bought a lot of fuel, and if you put them side and side, the mileage is not taking as much off. Then the actual business expenses, those can be actual vehicle expenses is what I should have put there, can be expensed off. So we can expense, let's say you went to a mechanic shop and they charged you $2,000 to fix the vehicle. If you have a hybrid use for it where it's personal and business use, then you have to track that. And then the percentage of it that you use for your business is what you can expense. Of course, but those are ways you can also expense your vehicle. So you can expense the fuel you purchased. You can expense any other expense with it. Another notable mention is the electric vehicle credit. The electric vehicle credit is a new credit. You can get up to $7,500 off of a vehicle for your business, right? So if you have a vehicle allotted to your business and it falls into a certain spec, you can get up to $7,500 off for that vehicle. Isn't that awesome? The only thing I would say is you have to make sure it has to be, there are different requirements. So there's you get a different percentage if it's not a brand new vehicle. It has to be purchased through an authorized dealer. And the vehicle parts, it has to be assembled, I believe, in North America. Of course, Canada, America, Mexico. However, the parts that they use to make those batteries, they have to be from authorized sources. So I believe for 2020, for this year, Tesla doesn't qualify, right? So I know that's a bummer for a few people because I do have some Tesla lovers in my clientele. All right, so let's go to the other option for business vehicle expenses. There's depreciation. You can depreciate your vehicle down based on the options that I've showed you before. The Section 179, the bonus, or makers, which is over a period of time, right? All right, let's check in with you guys. Let's see here. All right, so I have a couple of questions here. I was asked, about, I think I answered that one. So for an S Corp, someone just asked, so for an S Corp, it really depends on how much the business makes. Once you make that election, you can't change it for another 5 years generally without IRS permission. That's why I do recommend that you pay attention to your income. Be more strategic with where your business is going so you can know, okay, I am doing this because I project my business to grow to a certain amount. And of course, you would be diligent with making sure that you're tracking your payroll, putting yourself on payroll, right? I have another, right? I see a couple questions here. I think I answered some of them already. I think I answered some of these already. Let me see if I missed any questions because there are so many coming in. I will go back over it This chat is private. You can put your email in there and I can always send it back to you. When it comes to estimated payments, yes, you would make estimated payments for both federal and state, depending on where you live. And that saves you time. So if you've overpaid, they pay you back, right? All right, so let's go back to here. All right, so entertainment isn't deductible. So there's a little fine line there. So the only way entertainment would be deductible, right, is let's say I have a company of like 50 or 60 people, and then there's an office party, that would be deductible, right? The office party would be would be deductible, right? Other than that, if you're trying to wine and dine a client out and you take them out, if you take them to like, let's say a baseball match, the baseball match ticket is not deductible. But if you bought food, the meal is deductible. So entertainment isn't deductible anymore because, the IRS is a little trippy about that. And I do understand because sometimes I have clients who are like, are you sure it's not? It isn't. Only staff parties that you keep, those are fully expensed. But your personal entertainment is not. Let's say you bought a ticket to an event, and it's like those shows, those live shows, and it includes food. If you can distinguish the cost of the meal from the cost of the ticket, then the meal is deductible. And for 2021 and 2022, it was wonderful. It was 100% deductible, but for 2023's tax year, it's just 50%. So that was a bit of a bummer. All right, and when it says meals, not what you went to the grocery store and bought for your home, meals that are available to be consumed. And if you have employees, meals that you purchase for them for your convenience. So it's always with the IRS, they use the term ordinary and necessary. So you have to make sure the expenses you have are ordinary and necessary at all times. All right, so for my real estate persons that are in here, if you have real estate that you have held on to for a little time, and this is business real estate, right? Let's say you've held on to real estate for a little bit and it's appreciated significantly. Let's say 2020, because everything went up. Let's say you bought it for 200,000 and it's now valued at 400,000, and you depreciate, because you can depreciate real estate for your business. You can't depreciate real estate for your house, your personal use, unless it's partially business use. So let's say you have real estate and you're like, okay, I want to sell it. If you get an opportunity to sell it, the best way to save, which is what a lot of wealthy people do, the best way to save is to buy to exchange it. The best way to save is you can do a like-kind exchange. Where was I going? You can do a like-kind exchange. So if I have, let's say, a hotel in Florida, and I'm like, you know what? I think it's better to go up in Colorado and get one of those ski resort properties that I can exchange with someone in Colorado. As long as they're in the US with you, you can do an exchange, and that lowers your tax liability. You keep the basis from the depreciation you've had, and that's gold. So it really depends on, I'm not going to go into much detail because it really depends on the property that you're exchanging. They have to be in the US, can't be a personal property that you only use for personal reasons. And it's called like-kind exchange or Section 1031. All right, so that's something to think about there. All right. Another thing I wanted to look at, let me check the time. I'm just talking away. Let me check the time. Another thing I wanted to look at with you guys is the new tax rates for 2023 and 2024.